Hello, everyone, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and today I want to spend some time walking you through something that's quietly shaping every market you look at, whether you trade stocks, currencies, commodities, or longer term investments. We are talking about the global macro outlook for 2026, and more specifically, what really matters beneath the noise. A lot of people hear global macro and think it's all theory or something only economists and hedge funds worry about. But the reality is that macro forces decide whether trends last, whether volatility expands or contracts, and whether markets reward patience or punish complacency. And in 2026, macro matters more than it has in a very long time. What's different now is that we are no longer living in a world of easy answers. For years, growth was strong enough to hide inefficiencies, inflation was low enough to ignore, and central banks were willing to step in whenever markets wobbled. That world is gone. The global macro outlook for 2026 is defined by tighter conditions, slower growth, and much less margin for error. Let's start with growth, because this is the foundation everything else sits on. Global growth isn't collapsing, but it is structurally slower. That's an important distinction. We are not talking about a single recession or a bad cycle. We are talking about long-term forces like aging populations, shrinking workforces, lower productivity gains, and the fading boost from globalization. Developed economies are feeling this most clearly, but even emerging markets aren't immune. What this means is that growth is uneven. Some sectors, companies, and countries will still perform well, while others stagnate. Markets are becoming less forgiving of weak balance sheets, questionable business models, and over-leveraged structures. In this environment, simply being exposed to the market isn't enough. Selectivity matters again. Now, layer inflation on top of that slower growth, and the picture becomes more complex. A lot of people believe inflation is behind us because headline numbers came down from their peaks. But inflation didn't disappear. It changed form. In 2026, inflation is quieter but more persistent. Services inflation remains sticky. Housing costs are still elevated in many regions. Wages haven't fully normalized. And on top of that, structural forces like supply chain diversification, energy transition costs, and geopolitical fragmentation continue to apply upward pressure to prices. This kind of inflation is dangerous because it doesn't announce itself loudly. It quietly shapes policy decisions, interest rate expectations, and asset valuations. It acts like friction in the system. You feel it everywhere, even when you stop talking about it. And this is where central banks come in. For over a decade, markets were conditioned to expect central banks to rescue risk assets whenever things got uncomfortable. That conditioning is still present, but it's increasingly outdated. In 2026, central banks are constrained in ways they weren't before. Debt levels are high, political pressure is intense, and credibility on inflation matters more than supporting asset prices. Central banks are trying to balance preventing inflation from coming back, avoiding deep recessions, and keeping the financial system stable. Those goals don't always align, and that creates uncertainty. Markets can no longer assume rapid rate cuts or liquidity injections at the first sign of trouble. For traders, this changes the game. Monetary policy surprises matter again. Shifts in rate expectations can move currencies, bonds, equities, and commodities quickly. In the global macro outlook for 2026, central banks are no longer the market's safety net. They are one of its biggest sources of risk. China is another major piece of the puzzle, and one that's often misunderstood. China isn't trying to grow at all costs anymore. It's in the middle of a long, complicated transition away from debt-driven investment and toward consumption, technology, and domestic resilience. That transition is slow and messy. The property sector remains under pressure. Demographics are unfavorable. Regulatory shifts have reduced foreign investor confidence. But China still matters enormously. Small changes in Chinese demand can move global commodity markets. Policy signals influence emerging market sentiment. Currency management decisions ripple across Asia and beyond. In 2026, China's impact isn't about explosive growth. It's about marginal shifts that move markets at the edges, often when people least expect it. Then there's geopolitics, which has moved from the background to the center of macro analysis. Geopolitical risk is no longer an occasional shock. It's a constant variable. Trade fragmentation, sanctions, strategic competition, and regional conflicts are reshaping supply chains and capital flows. Companies are prioritizing resilience over efficiency. Governments are willing to sacrifice economic optimization for national security. Markets are pricing political risk premiums into assets, whether it's in currencies, commodities, defense-related sectors, or energy markets. Ignoring geopolitics in 2026 isn't just naive. It's dangerous. Energy and commodities sit right at the intersection of geopolitics, inflation, and growth. The global economy is transitioning toward cleaner energy, but it's doing so while still relying heavily on fossil fuels. That dual system creates tension. Underinvestment in traditional energy can cause supply shortages, while massive investment in renewables drives demand for critical materials like copper, lithium, and rare earth elements. These materials are essential for electric vehicles, batteries, and infrastructure. That demand isn't cyclical. It's structural. From a macro perspective, this creates long-term support for certain commodities and adds an inflationary undertone to the global economy. Technology adds another layer of complexity. Artificial intelligence, automation, and data-driven platforms can dramatically improve productivity, but only for those who implement them effectively. This creates divergence. Some companies and countries pull ahead. Others fall behind. In the global macro outlook for 2026, technology is both a growth engine and a source of disruption. Markets are becoming more discerning. They're less interested in hype and more focused on whether innovation translates into sustainable cash flow. Real productivity gains matter. Stories don't. All of these forces feed directly into financial markets. Markets in 2026 aren't chaotic, but they are demanding. Equity leadership rotates more frequently. Fixed income is relevant again, offering yield but requiring careful risk management. Currency markets reflect policy divergence and geopolitical tension. Volatility is higher, but it's purposeful. This kind of environment rewards preparation, not prediction. And that's where tools matter. If you're trading or investing in a macro-driven market, you need access to reliable data, intuitive analysis tools, and efficient execution. This is why I recommend taking a look at the world-class, cutting-edge, user-friendly trading platform app from Crystal Ball Markets. It's built to help traders analyze markets clearly, manage risk effectively, and act with confidence in fast-moving conditions. You can explore it at crystalballmarkets.com/platform. Learning also matters more than ever. Understanding how inflation, interest rates, geopolitics, and growth interact isn't optional anymore. It's an edge. And that learning has to be practical, not academic. That's why I also encourage you to check out the beginner-friendly trading, investing, macro, and financial markets podcasts from Crystal Ball Markets. They break down complex topics into clear, accessible conversations that actually help you think better about markets. You can find them at rss.com/podcast/Crystal Ball Markets. So when we talk about the global macro outlook for 2026, what really matters isn't trying to predict the future with certainty. It's understanding the forces at work, managing risk intelligently, and staying flexible in a world that's changing faster than most people realize. Markets don't reward confidence. They reward preparation. And that's what navigating 2026 is really about. Thanks for listening to Financial Market Insights for Traders. I'm Sophia, and I'll speak to you again in the next episode.